This is Derek Iswell, Chief Investment Officer for Shelton Capital Management with the Shelton CIO Minute. We've had a lot of market activity in the last week after the release of positive CPI and PPI data last Thursday and Monday, with the NASDAQ itself rising over 7% in one single day, a 2.5 standard deviation move. What's the message that the market is interpreting from all this activity? Well, first of all, inflation has most certainly peaked and is starting to go down, and perhaps at an even faster rate than we had originally anticipated. And second of all, based on that, the Fed is going to pause the rate hike cycle and maybe even start to lower rates sooner rather than later. Now, certainly the thought that inflation has peaked has certainly had a lot of uncertainty removed from it. But many of the inputs into that perspective haven't really changed. We've had a lot of anecdotal evidence of layoffs in the tech sector, but broader employment trends are still strong. And so as a result, the Fed really hasn't officially changed their message yet. And in previous episodes of our extended inflation saga, what happens then is the market, after perceiving an end to this rate hike cycle and seeing equity markets rise, have the Fed then squash those dreams and that accompanying rally with further hawkish comments. Now, maybe this doesn't happen this time. Maybe the market's right. Maybe the rate hike cycle is over. But the challenge here is that in the past, a change in the direction of Fed rates has not always meant a strong equity market rally. Our short-term memory focuses on 2018 to 2020, when dovish sentiment from the Fed helped trigger a couple of very strong rallies. One at the end of 2018, the so-called Christmas rally, which was the end of the last hike cycle. And then again, when the pandemic struck, as aggressive Fed rate activity triggered a second rally right after the pandemic had started. But in previous historical changes in the Fed's perspective, say 74, 1981, 2000, 2007, these episodes were at best mixed for the equity markets. And in some cases, we saw considerable equity market declines. So by itself, a Fed pivot is not likely to serve as a catalyst for a stronger equity market. In the next CIO Minute, we'll discuss a better way to view the Fed's activity. For more information about Shelton Capital or our suite of products, please contact your local Shelton Capital representative. This has been a Shelton CIO Minute.